Welcome, beautiful people. Today we will discuss a few stocks that have been beaten down by market volatility to a point where they look extremely attractive. And stick around because some of these companies look downright uninvestable, but with the right strategy, they can surprise the market. For example, most analysts do not want to invest in Delta Corp right now because of their tax issues. But this company has gone through the 08 crash, the 13 taper tantrum, and even the COVID crash. Their current problems are nothing compared to those massive bear markets. Very basically, the company received a notice to pay a GST amount of 33,500 crores for its casino business when the company's total sales are about 800 crores. The argument that the GST Commission makes is that tax should be imposed on total bet value instead of the money that the casino actually makes. That is like asking a bank to pay tax on the entire value of transactions by all its clients instead of the money it makes on the interest. Taxation simply does not work that way. So it is very likely to be eventually overturned by the Supreme Court. However, this creates a wonderful opportunity for patient investors. A company with 3,000 crores in reserves and assets now has a market cap of 2,000 crores. The market has to eventually reevaluate this company. And when it does, the stock might go 5x in 1 year. Now I cannot know when that will happen, so I'm buying in tranches. Next up, we have Sanofi India, which I must admit I have a very soft spot for. This stock is everything a positional investor wants. It is part of one of the world's largest multinational pharmaceutical companies, it pays good dividends and has a proven track record of returns. Most importantly, it is one of those cyclical stocks that should be bought at large falls because it can deliver very sharp returns with a fast turnaround time. If we had bought into this Sanofi at any dip of more than 20%, we would have cleared a more than 30% CAGR in 3 years at any point in history. Its products span the entire medical library with recent launches in diabetes, bone marrow transplants and RSV. The company is innovating and partnering with firms like Dr. Reddy's and Cipla to market its products. Had a 30% correction and with a 2-year time horizon, it can make for a safe but high beta play. CMS Infosystems is next on the agenda and this company suffers from a misunderstanding. Given its nature of business when it gained popularity, the market tends to ignore its pivot in business. CMS is actively expanding its digital presence and developing technology-driven services to meet the growing demand in the digital payments market, even as it maintains its large cash management business. Its CEO, Mr. Rajiv Kaul, has repeatedly stated his intentions to reorient the company to fit into a world of digital payments. He has reinforced his claims by almost doubling his stake in the company. If the leader of a company shows such strong belief, it might be worth a look at least. Next up is KNR Construction, which is the play on India's public infrastructure. Now, there are a plethora of stocks in this space that are available at very attractive valuations. That's because this entire sector has been derated because the government has shifted its focus from city infrastructure to rural infrastructure over the last 2 budgets. So, as KNR's legacy projects reached completion and new contracts slowed down due to reduced government spending, the stock's quarterly results have naturally suffered. However, this is the perfect time to pick up such companies since India's growth story does not seem to be slowing down yet. Eventually, the government will shift its focus back to infrastructure and that is when these stocks will go 3x in a year. It is very difficult to time such swift movements, so an SIP over 6 months seems like the ideal way to buy into this whole sector. Other than KNR Construction, I would also go for PNC Infra and GR Infra in this basket. Then we have Rallis India, and this company is suffering for 3 main reasons: declining demand in the crop care business, high inventory pileup, and high competition primarily from Chinese firms. The demand in crop care is normalizing again, while the high inventory has also played out. The sudden increase in competition also seems to be finding balance as the US and India move closer to a trade deal. So, while there may still be limited downside to the stock, the risks to reward seems favorable here. Rallis India is also expanding its bio-based offerings through the launch of its new brand New Code, which includes a range of biological solutions like biofertilizers, biostimulants and biopesticides aimed at improving soil and plant health. The rising popularity of organic food should directly aid in New Code's growth. Its promoters, the Tata Group, have also increased their stake in the company, hinting at the potential for growth. Next is Acumen's Drugs, and this is a very underrated stock. It controls 1/3 of the entire CDMO market in India, gaining about 5% of the market in just the last 5 years. It also manufactures for basically every pharmaceutical giant in India, yet its valuations are half that of a similar player like Divi's Lab. The current undervaluation does not seem sustainable, and the market has to eventually correct course and give this company the credit it deserves. As a long-term investment, Acumen's Drugs makes a very strong case to be included in any portfolio. Next is Colgate-Palmolive, and the logic here is quite straightforward. It's a blue chip stock that is corrected by nearly 50%. The reason behind the fall is simply poor quarterly results and associated FIS selling. The poor results have been caused by local competition and slower growth due to the company's focus on the small vertical of dental care. While there may be periods such as these where Colgate's concentrated market is challenged, in the long term, the company's innovations remain targeted. The fall, in fact, creates a rare opportunity to make sharp returns with minimal risk. While the stock may correct further, perhaps up to 1800, which was its previous resistance, the risk to reward is extremely favorable. Finally, we have a company that is my recent favorite. I'm looking for any large falls close to 34,000 to buy into this stock for the long term. It has a moat around its products to the point where I'm confident that all of us have its products in our homes. It also boasts one of the highest ROCs among established players, and it is Page Industries, the company that created Jockey and promotes Speedo in India. It is an expensive share in rupee terms, but it is also a high beta company. Buying such stocks when they're 30 to 40% corrected from the top is a surefire way to make outsized returns in a confusing market.